And that's a pretty big mistake that I see a lot of novice traders making is they put the strikes just too far away from the stock price. They run and hide even though they might actually want to get assigned. They just can't help themselves. And man, I will tell you, I've fallen into that trap before too. It's very easy to do. Geez, this is pretty good here if I get assigned, but it'd be so much better if I get assigned $5. I'm just going to get a little extra wiggle room there. Well, no, we don't really want the wiggle room for the trade motivation.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Dan Passarelli here, and welcome, Wealth Building family. Welcome to episode 33, Who, What, and Why. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. Help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. If you're already a listener and already subscribed, you can support the show with a paid subscription. And when you do, it's well worth your while. You'll get video extra podcast episodes so you can get hands-on video training on the things we talk about in the audio podcast. You'll get subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash-secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual activity options alerts and options income trades, and so much more. And the best part is your paid subscription helps keep this show on the air. So I'd like to take a minute to thank our newest paid subscribers. A big welcome and thank you to Leon, Dirk H., Lynn G., Arthur B., Donna P., and TJ. To join this list of Wealth Building paid subscribers, just go to wealthbuildingpodcast.com and choose your subscription level. Today, I want to focus on the who, the what, and the why of cycling into wheel trades. Let's start out with who. Who does trade the wheel? Now, it's one of the most commonly traded options strategies, and that's probably for a couple of reasons. It's very conservative. It's for investors and not really as much for traders, although traders can use it. That means that it's short term, doesn't require a whole mess of labor and that kind of thing. So it's mostly these conservative investor types. I would say my wheel trades, I use it as a conservative investor, maybe, 97% of the time. And the other 3% for me personally is for risk taking. And we do have some risk taking traders sometimes using covered calls and cash secured puts, sometimes shot takers who are trying to skate, which, I tend to think it's better for credit spreads if that's your objective, but you can use it for that. And then there's everything in between those very conservative investors and those more risk-taking active traders. So it's a lot of people. No wonder it's one of the most commonly traded strategies. Next comes the what. And the what we talked about quite a bit already. We're talking about cycling into wheel trades. We spent a good amount of time already talking about that. That's when maybe we have a stock and we sell a call, and we skate and we're happy about that. So we sell another one and we skate and we're happy about that. So we sell another one. Then we get assigned and we say, okay, I'll sell a cash secured puts and skates and get assigned and say, okay, now I have the stock, sell another call. That's what we're talking about. But the why is an underrated topic. Why do people trade the wheel? Why do they trade in cycles like I talk about? Well, that's what we really want to focus on today. And so we're going to talk about a lot of the motivations that people have for selling covered calls, for selling cash secured puts, for doing them as the wheel, and for doing them in cycles. Now let's get on with it. There's basically kind of an infinite potential set of permutations that can play out within a cycle that makes you go on to that first or second or third or next play in a cycle. But they all start out the same. And depending on the objective, well, they basically end the same. So let's start out. This is kind of in the book. This is going to be sort of bullet point fashion. So imagine that. And here's how we start. For folks who sell a put, well, the major objectives are to do one of two things. They're to A, sell the put, to get assigned, to trade into the stock, to get assigned and buy the stock. And I call that the trade objective, trading into the stock. Or the second reason that someone would sell a cash secured put is just to capture the premium, the skate objective. I'm going to sell this put because there's support down there. I don't think that the stock is going to get down there. And so this is my way of stealing a little money out of the market. That's cash secured put. A covered call, there's two objectives there, and they're the same, the skate and the trade objective. So the trade objective, just working backwards, is, hey, I've got this stock and it's getting a little expensive, whatever. I'll get into all those details in a second. I'm going to sell this call because I want to get assigned and sell the stock. That's the trade objective. Want to sell the call, so I trade out of the stock. And then the other objective is, hey, I've got this stock. I'm going to sell this call because I don't think the stock is going to get up there. There's big resistance above. This is the skate objective. I just want to steal a little money out of the market. Now, those four motivations, two for the put, two for the call, and they're both kind of the same, skate or trade. Those are very distilled. Those are sort of the high-level bullet points, the ones furthest to the left. But there are many sub-motives. I'm going to start out with maybe the major sub-motives for each of those, and then, hey, we'll deviate, we'll digress, we'll detail it, all the D words that you can think of. All right, here we go. Selling a put to trade into a stock. That is selling a cash secured put with the trade motivation. Here, of course, I want to buy the stock, and a really great motivation is to buy the stock for less than the current market price because I want to hold it for a long, long time. So there's a sub-motivation, but if this was an outline that you're looking at, bullet point outline that you're looking at, there'd be a bunch of sub-points below that. Okay, sure. I want to buy the stock, but why? Well, I want to buy the stock for me personally. Most of the time, it's because I do some fundamental analysis, I guess you'll say. There's a certain number of ratios and stuff that I look at. Or maybe it could be a dividend play. We'll get back to dividend plays in a second. Hold on a second. But if the ratios are good, or they will be good if it gets down to a lower price. That's where I do this all the time, man. I put in order to sell a put at a strike price where I think the stock level is attractive. Now, the thing with that is you can end up balancing out your trade versus skate motivation, because if you're like, okay, well, the PE ratio and the price to book ratio, they're okay here, but you do a little algebra. With the stock 5% lower, $10 lower, whatever, yeah, that's where the PE ratio, the price to book ratio, the price to operating cash flow ratio, yeah, that's where they all look really good. I'm going to sell a put at a strike price $5 lower. And then you execute the put and you have the strike price $5 lower, but the stock doesn't go $5 lower. So your trade motivation is kind of goofed up. You end up skating and then, okay, well, I got to do it again. And that's a pretty big mistake that I see a lot of novice traders making, is they put the strikes just too far away from the stock price. They run and hide even though they might actually want to get assigned. They just can't help themselves. And man, I will tell you, I've fallen into that trap before too. It's very easy to do. Geez, this is pretty good here if I get assigned, but it'd be so much better if I get assigned $5. I'm just going to get a little extra wiggle room there. Well, no, we don't really want the wiggle room for the trade motivation. We want to get more aggressive with that strike price, sell at the monies. And I'll tell you what, you see that pretty often in the market. When we see unusual activity, which our paid subscribers get that, the credit spreads that our paid subscribers see, we send out a couple of those a week. Those are made by big professional traders. You would be very surprised, if you're not subscribed yet, to see that a lot of them are big professional traders. They're selling 500, 1,000, 2,000 puts right at the money, and then just a lower strike put for protection. So this is something that the best wheel traders do. When you're trying to get assigned, you sell close to the money strike prices, or at the money strike prices, or even a little bit in the money strike prices. Okay, there's sub motivation 1 for selling a put to trade into the stock. Sub motivation 2, to buy a stock to begin the wheel. And then if we get assigned, sell calls against it just to get into the wheel. I don't have the stock, but I think this is a great wheel candidate. Boom, I sell a put. And that's one too, where I think people hide a little bit too much for cover. They give themselves too much wiggle room, and they skate and they skate and they skate. And maybe they're not really getting enough premium to make it worth it. That's something that I'm actually writing about in the book now. I'm a couple chapters ahead in my writing, which we'll talk about on future episodes here. But I mean, I don't know, skating is part of the wheel, but if you want to get the most out of the option premium, remember, time premium is what makes the wheel attractive. If I get assigned, I'm buying the stock, the strike price minus the time premium I got. And if the stock doesn't fall below the strike more than the time premium, that's like what I call the sweet spot, where you can end up really doing well, buying the stock below where you could have bought it on your own, which is really pretty awesome, isn't it? The third sub motivation for selling a put to trade into the stock is to buy back a stock that got sold from a previous covered call assignment. You're basically already in the wheel and continuing the wheel. Those are our 3 motivations when selling a put to trade into a stock. Now, let's talk about the sub motivations for selling a put to skate, to capture premium instead of get assigned and buy the stock? Well, the motivation there is sometimes it's to accept risk and potentially a lot of risk to grab a quick profit. And when we do this, and I'll tell you what, I mean, it wasn't really my motivation for the show to talk about what are some mistakes and best practices, but I guess it just sort of comes up. So, hey, we'll talk about it. When more aggressive traders sell a put with the skate motivation because they don't want to get assigned, they just want to grab a quick profit. Well, I mean, I'll tell you what, I see a lot of people making a mistake there by selling too far out of the money. When we think in terms of the log normal distribution, which as an option trader of any sort, you kind of have to get your brain around that statistically based thinking. If I'm selling a put to grab a quick profit, I want to get more wiggle room there. I do want to sell a more out of the money strike in that case. But if I do sell that out of the money put, if I get assigned, if I'm only collecting a very, very small amount, like 0.1% of the stock price, which I encourage you to look at, the percentage of premium you're getting relative to the stock price, really the strike price, technically, when it comes to selling cash secured puts, then, I mean, your risk is the whole stock price. I mean, the stock can theoretically go to zero, which almost never happens in a hurry. I mean, with Enron, that happened. I mean, it's very, very uncommon that a stock just goes from 100 to zero overnight, but it can happen. And you have to consider that that black swan type event can happen. So if you're risking $100 to make 10 cents, geez, man, I don't know. I don't see that as a great trade. You really have to be more aggressive there too. And you really have to set very, very specific criteria. Hey, the stock's at 100. There's very strong support at 92 and so much more support at 90. And the stock is trending higher on the RSI. Okay, now I've got some concrete reasons for why I think the stock is not going to go below 90. And then I figure out if the juice is worth the squeeze, as they say, am I getting enough premium as a percentage of the strike price to make this risk reward worth it? Okay, so there's two. And you know what? Here's a good idea. I wasn't necessarily planning on this, but I might throw this up as, I don't know if it'll be a video extra, but an extra of this outline of the motivations. I'm going to do that. I'll talk to Bobby on how the best way to do that is. I just think it'll be easier for you to have a record of it that you can look at. Okay, so there's the first sub motivation for selling a cash secured put with the skate motivation. The second one is to build cash to lower the cost basis, or what I call the cumulative discount effect, of eventually owning the stock. So this is another one that kind of blurs the lines a little bit between the skate and trade. Like this one, ultimately, you do want to get assigned, but maybe not quite right now. And I've got a couple of stocks in my portfolio right now that fit that criteria. Some of the stocks that I really like to do that on are ones that are more growth stocks where the PE ratio is going to be high, but they've got a lot of good things going for them. They've got a novel idea. They've got a big, what Warren Buffett calls a moat, kind of separates them from the competition. And they have a good chance of taking off, not necessarily being the next Amazon or something like that, but that kind of idea. So those I do this sub motivation with all the time. Selling a put, hopefully to skate, so that I can build cash to lower the cost basis because I know it's a game of chicken and eventually I'm going to get assigned. But I've got one right now that's about a $92 stock or something. And I sold the 90 puts, come around towards expiration, buy them back at a nickel, locking in a $1.50, a $1.80, $2 or whatever, and then sell them again for another $1.50 or something, buy them back at a nickel, sell them again at another $1.50, 60, 70, 80. And then, hey, when that game of chicken ends and I get assigned, I'm not just buying the stock $1 below the strike. I'm buying the stock $1 lower plus $1.60 lower plus $1.80 lower. Oh, I'm not buying the stock at 90. I'm effectively buying it at 80. And now that cost basis looks really attractive. Now that PE ratio looks really attractive because even though I'm getting assigned on the 90 strike, I'm effectively buying it at 80. So I'm taking price divided by earnings. I'm not taking the actual stock price. I'm taking my effective purchase price, factoring in the cumulative discount effect. So that can be an awesome motivation. The third sub motivation for selling a cash secured put with the skate motivation is as a proxy strategy for holding the stock over time. Now, this is not really necessarily great for dividend stocks or anything like that, because those, I don't want a proxy for holding the stock. I want to hold the stock so I actually get the dividends. But if the stock doesn't pay dividends, I mean, hey, man, I can just keep selling pretty close to the money put, probably at the money on average, sometimes a little out, sometimes a little in, but pretty close to at the money. And then, hey, man, if I skate on this one, great. I keep that premium. That adds up in my cumulative discount effect. And then maybe next time I skate, but I skate too much. I'm making air quotes here, too much. And the stock really takes off to the upside. Holy crap, it's $30 higher. Geez, now I can't sell that same strike put again because they're worthless. Ah, geez. Well, that can be okay too, because I take that cumulative discount effect, all the premiums that I collected for that stock at whatever strike, and really calls or puts, and I can just say, oh, well, okay. I'll take that cumulative discount effect and add it to that strike where I wanted to get assigned because I've got that extra stuff. So I can sell a strike that much higher. And if I get assigned, I'm still getting assigned at that original strike, just using that cumulative discount effect a different way. So it still becomes a proxy for holding the stock over time. Man, I'll tell you what, this is probably a few years ago before I really had this dialed in. There was a stock where that happened to me and the stock just really took off. And I'm like, oh, crap, man, I only made like $2 on this put and the stock's up $30. Man, I should have bought the stock. You always think that in hindsight, right? I mean, you shouldn't. I guess I tend to not think that way anymore, but that's how people think when they first start trading cash secured puts. But then I went back and I looked at all the premiums that I collected because it was a wheel trade. Sometimes I'd had cash secured puts, sometimes I'd had covered calls. And I added them all up for the last like 12 months or so. And I'm like, holy crap. The stock's up $30, but I collected $33 in option premium over the last year. Well, okay, that's fine. I don't care. That works. So selling cash secured puts as a proxy strategy for holding the stock over time, it can really work when you just kind of put your faith into it, really. And hey, trust but verify, keep a spreadsheet as well, adding up all those premiums so that you can look back and say, oh, well, I collected this many premiums. It's okay if it gapped up that much. So those are the sub motivations for selling a cash secured put with the trade motivation and selling a cash secured put for the skate motivation. Now let's move on to covered calls. Let's start out with selling a covered call with the trade motivation, meaning I want to get assigned. Well, a huge motivation is to sell an over overpriced stock. Okay, for fundamental type investors, if I'm looking at my ratios, a really good fundamental type investor looking at my intrinsic value, and that's what gets me into a stock, whether I just buy it or sell a cash cured put to get into it. Now I've got this stock, but the whole purpose of buying that stock is that it's underpriced, and we're thinking one day it should end up overpriced because there's noise in the market, right? It's not full, strong form, efficient market like the Chicago School of Economics folks used to think about it. There's noise. And chances are over time, a lot of those stocks are going to end up in an overpriced scenario. And I've got a couple of those too that I've got covered calls on right now. I've used all these motivations at some point. So I put in a covered call at a strike price where I think the stock is overpriced. Now, this is one where you can do it with sort of a wish list type scenario. Yeah, the stock is starting to get overpriced, but it's not overpriced here. But boy, 10% higher. Yeah, that's where I want to sell the stock. But the thing is you still want to get enough for that premium. If you're selling a stock like 10% out of the money because that's where it's really overpriced and you want to sell it, I mean, you might have to go out many weeks or probably a few months to get a big enough premium to make that worth it. And if it's a few months, you're going to have a few earning cycles in the interim where all those ratios and that intrinsic value, it's all going to change once you get a couple of new earnings announcements announced. So the reason why I'm saying all this is you probably want to use that on a stock that already is overpriced and not go that far away from the money. You can, you just think of it as a limit order, but again, if it's a limit order, it's only a limit order if the stock actually goes above that strike and is above that strike at expiration. A big risk there is, oh, I'm thinking about this as a limit order, and then it goes up, it's above the strike price, but then some crazy news comes out and the stock tanks and your limit order didn't actually get filled. Air quote limit order didn't actually get filled. So, yeah, you really want to do those pretty close to the money. Second sub motivation for selling a covered call to trade out of a stock is to end a cycle and go into cash. Hey, look, this cycle paid off pretty good. At this point, I don't really know why I'm holding this stock. It bounced off support and resistance, and I did this like a year ago, and I've just been doing this wheel, and I'm looking at the technicals, and I don't even know why I'm holding this. I just ought to get out of it. There's not a lot of juice in the implied volatility. It's underpriced. Let's get out of it. And there, honestly, it's usually best to sell an at the money covered call too, or close to the money. Submotivation number 3 for selling a covered call with the trade motivation: to continue the cycle or recycle and get assigned and sell a put. This is especially good if it doesn't pay dividends. Hey, I don't need to hold the stock. It doesn't matter. Or if the dividend yield is so low that you're just better off being actually in cash. You can make more in the high yield money market accounts at your brokerage firm than you make holding the stock and collecting the dividends. Like, that's the thing. I did that calculation just today for my, what stock was it? I mean, the AT&T stock, it's about the same as what I can get just earning interest in the account. I think it was GM, now that I think about it. I did the calculation there, and it's like, I can get 1% on dividends, or if I'm holding cash and selling puts, I can get 4% in interest. Okay, kind of a no-brainer. I'll just keep the wheel going and not really worry about the dividends. And if I get assigned on the calls, I sell a put. If I get assigned on the put, sell a call. Just keep the cycle going. Submotivation 4 for selling a covered call with the trade motivation: to sell a stock that I bought from a previous put assignment. It's just part of the cycle, right? That one's kind of related to the last motivation, but maybe, I mean, this is probably earlier on in that cycle, right? I started out with a put and I got a sign. Okay, now I sell a call. And as opposed to, okay, I've been doing this cycle for a year. Now it's time to sell a call. And then finally, we get the sub motivations for selling a covered call with the skate motivation, the premium capture motivations. Number one, well, guess what? Just to accept some risk and grab a quick profit. Hey, I got this stock and man, it's had a pretty good run, but it's coming up on resistance. I'm going to bet against it not going over resistance. Resistance is strong. There's actually a reversal set up in the RSI. We're across above the 70 line and back down below. That usually indicates a pullback. Yeah, I'm going to bet against this stock that I own going up above there. It's almost kind of like a hedge in a way, right? Now, you don't want to do this if you own the stock from a teeny weeny cost basis and it's in a taxable account, right? Now, full disclosure, I hire an accountant to do my taxes. I am not a tax expert by any stretch of the imagination. So I'm not giving tax advice, but I mean, it's common sense if there's capital gains tax involved that if I inherited this stock from my grandfather, it's Apple stock, I own it at a 2-cent cost basis. Well, I probably don't want to actually sell the stock and pay taxes on it. So, yeah. So that's one of the risks of just selling a call to grab a quick profit. And plus, you definitely want to balance how much of the premium am I getting on this versus how risky is it to get assigned and end up selling a stock that I don't want or have to avoid assignment by buying back a call so that I don't sell a stock that I don't want to sell. And then finally, no, not even finally, there's still a couple more motivations here. The second motivation for selling a covered call with the skate motivation is to build cash to lower the cost basis, the cumulative discount effect on a stock. So maybe there, I decide, all right, I've got this stock and it's doing okay. There's earnings have been kind of weakening a little bit lately, or, geez, man, it's been kind of in this channel lately. I'm afraid it could go down. It's just a little above where I bought it. Hey, I can sell a covered call and maybe I bought the stock at, I don't know, 180 and it's been bouncing around between 150 and 200. Okay, well, if I can, on the upswing, if I can sell a covered call at the 200 strike and that holds, maybe I sell that for $2.50 and I do that a couple of times. Okay, well, now I don't own the stock at $1.80. Okay, now my cost basis is not $180. Now it's $177.50. But if I do that again on the second one, well, now it's $175. And so if we keep staying in that range, I can feel a lot better about owning that stock because my effective cost basis gets lower. The third motivation for selling a covered call with the skate motivation is to raise the cumulative if called return. So this is kind of the same thing, but instead of wanting to hold on to the stock, but lowering its cost basis in case I end up having to sell the stock at market price when I've got all this extra premium, which actually makes it a better price for me. The if called return, where if I'm just going to keep selling that 200 strike, this stock, there's pretty good reason for me to believe that it's going to go above 200, but it's taking its own sweet time. Okay, I'll sell that 200 strike for $2.50. If I get assigned, then the if called return is the strike price, 200 plus the premium, so $202.50. But if I skate on that like twice, or 3 times or 4 times, okay, sure, I might get assigned at that 200 strike. But if I collected $10 in premium over the last 4 trades, it's like I'm selling that stock at $210. And as you can see, and as you can imagine, a lot of these sub motivations, they do sort of bleed into one another. There is overlap, but some are sort of the primary motivations and the others are sort of secondary motivations. Now, there can be as many reasons for each of these as there are investors, times the number of ideas that each investor might have. But I would say that the ones I talked about are the most common. There could be some that come into play with trying to trade the dividend yield, like, hey, when it's down lower, I'm going to sell puts to get assigned because the dividend yield is good there. And then when the stock is higher and the dividend yield is not as good anymore, I'll sell calls to get out of it. There's another motivation. I mean, that is a bona fide one. I mean, I use that one. I mean, the only thing with that one is you really don't have to use the call to sell out of a stock that you own, that you bought at a good dividend yield, because you basically lock in that dividend yield. Does that make sense? Like, if when the stock gets down to 70, I look at the dividends that I expect to be paid over the next year and, oh, okay, I can make 5.5% dividend yield on this if I get assigned and buy the stock at an effective price of 70. Okay, great. And then you do. And now you own the stock. Okay, now it goes up to, let's say a year passes or 9 months pass, and now it's up at 125. Now, if I divide the next 4 dividends that I expect to get combined, divided by 125, that higher stock price, maybe now the dividend yield is only like 3% and it's not good. It doesn't really matter because what I paid for that stream of income is still $70 a share. It doesn't matter if the dividend yield is no longer attractive. That's only if I wanted to buy more. So I don't actually have to sell out of it. But I mean, if you find a better opportunity, then hey, great, use the covered call to sell out of that. And then I guess you could kind of think of there are motivations for continuing the cycle, which bleeds into kind of everything that we talked about, but it's a little bit different, I think. A cycle is continued until the objective is met of locking in a profit on the option component of the series of trades, or you decide to end it early without locking in a profit on the option component because maybe some other objective is met, such as trading into the stock or whatever, and selling options is no longer viable because they're underpriced. And this ties into my personal definition of what I call a cycle. A cycle is like if I sell a put for $1 and the stock goes down through it, like maybe I want to skate, right? The stock goes down through it and I have to buy that put back for $2.50. Okay, well, I lost $1.50. This is where a lot of wheel traders who have less experience with this will be like, oh, well, this sucks. I'm never doing that again. The opposite is what you should think. Oh, okay, I've got to do that again so that I can bring in more premium to make up for the premium that I lost. And this is not like chasing it. This is actually a statistically sound practice. It's kind of the only way that this actually does work. I just sell more and sell more and sell more and sell more and sell more premium because the stock's not going to keep going down through your strike forever. There's a little bit of the martingale strategy involved there. I mean, yeah, I guess it could theoretically. And hey, you know what? If you make 5,000 wheel trades in your life, that might happen once and it sucks. But on all the other stocks, you'll make that back, I think. So yeah, the cycle is, I sold this put at $1 and now I have to buy it back at $2.50. I'm down $1.50, but I sell another put at $1.25. Now I'm only down 25 cents. I sell another one at 75 cents, skate on that one also. So I actually made 50 cents. Boom. On those 3 trades, it took me 3 trades to lock in 50 cents. That is a completed cycle. And so that first point that I brought up, the objective is met by locking in a profit on the option component of a series of trades. That's what I mean by locking it in, by ultimately finishing a series that has a profit. And if I wanted to just close it all out and wash my hands, I can walk away with a profit. And another thing to point out here too is that within a cycle, an investor could take assignment on a call or on a put, and that doesn't necessarily end the cycle. If you're still down money on it, you're still, if I got a sign on the put, well, now I'm going to sell a call. I'm taking in more premium, and I'm going to add all that together, plus or minus my positive or negative scalp on the stock too. So that's another thing to consider. In defining a cycle, let's put this idea about locking in a profit or losing on the option component. Let's put it under the microscope. To be very clear, option positions make or lose money dynamically as the market rises and falls and time passes and volatility changes, and even as expectations for future interest rates and dividends payments change. And those intraday profits or losses on inventoried option positions, they're real. That money is indeed made or lost, even if the position is still open and not closed, locked in. The cycle ends when the profit is locked in. While locking in the profit or loss doesn't make it any more real, it is the cutoff point that defines the end of a cycle. And that about wraps it up for this show. But before you go, don't miss a single episode. Binge it, baby. Please make sure that you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, YouTube, or whatever it may be. And if you would be so kind as to leave a comment, I would surely appreciate it, as the more comments that are left, the higher the service ranks us, and that means together we can grow the Wealth Building with Options community, and everybody benefits. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.